Hi there, I'm Sashi Sivram Krishna and welcome to my course Macroeconomics, a Modern Money Theory Perspective. We are in part 1 of the course Macroeconomics and Money. In lecture 26, I will make a few comments on balance sheets and T accounts. Macroeconomists are generally unaware of accounting principles as well as the mechanics of accounting. This leaves them with a rather fuzzy understanding of stock flow relationships, especially relating to money and credit, and therefore their analysis sometimes lacks stock flow consistency. Stocks of money and credit are captured through balance sheets, whereas flows are captured through a T account analysis. Economic commentators as well as the media too tend to ignore accounting analysis before presenting their results. They focus rather on capturing the headlines rather than grind through mundane accounting relationships. As Eric Timoin puts it, accounting is tedious, but one must get a good grasp of key accounting concepts to understand financial mechanics. Double entry bookkeeping ensures consistency, and by consistency he means stock flow consistency. In other words, if you cannot put your reasoning in terms of a balance sheet, then there must be a problem with your logic. So very often economists get only half the picture right. They tend to ignore the other half that we can easily understand when we put things into balance sheets and into T accounts. Just a very simple example. Public debt is looked at as a problem. Very rarely do we see the other half of public debt, which must be a financial asset which is held by somebody. If public debt is a liability, a financial liability, then there must be a financial asset which corresponds to this financial liability. The question arises, who owns the financial asset? If economists were to consider this half of public debt, perhaps there wouldn't be such alarm over rising public debt as there is today. Let me also quote Hyman Minsky on what he says about the need for stock flow consistency. The alternative to beginning one's theorizing about capitalist economies by positing utility functions over the reals and production functions with something labeled K, called capital, as a variable, is to begin with interlocking balance sheets of the economy. So Hyman Minsky too propagates the use of balance sheet analysis of T accounts in understanding money and monetary flows through the economy. Very often economists try to model the economy using abstraction of individuals wanting to maximize utility, of firms wanting to maximize profits, and they use concepts like utility functions and production functions to get some insights into how the economy might work. While we do not want to reject the methodology propagated by mainstream economists, very often in macroeconomics, especially in understanding money, balance sheet analysis and T account analysis are indispensable. Let me end with a few limitations of balance sheets, if we can actually call those as limitations, but something that we have to keep in mind. Balance sheets do not always reflect realities. For example, assets like property or stocks and bonds which are recorded on an entity's balance sheet, for example, a household's balance sheet, might not reflect their true values. Market prices tend to fluctuate a lot, whereas the balance sheet normally would record purchase of assets like property or stocks at their purchase price. And in some cases, in the case of physical assets, we might also deduct some depreciation from these assets. Nonetheless, the market value might be very different from such prices, and these do not get reflected on the balance sheet. Also, when entities extend loans, they take in collaterals. These collaterals might be once again financial assets or might be even physical assets. The market prices might be quite different from what is shown on the balance sheet. And finally, and this is something that is to be highlighted, is that while balance sheets maintain stock flow consistency, they do not establish cause effect. Very often economists need to work with cause and effect. For instance, we might grapple with the issue as to whether investment causes savings through increases in income, or do savings get channelized into investment spending and then increase incomes. This is something which cannot be established purely on the basis of balance sheets, and it is a limitation that we must work around and work through, as we will see in other parts of this course.